Hey everybody, this is Jim at SP500chart.com. It's April 11th, 2013, 4:30 in the afternoon here on the East Coast. Before we get started looking at the chart, I want to remind you, as always, that the website and the video are for educational purposes only, and nothing stated at the site or in the video is intended to be used as investment advice. I can draw lines on charts, but you have to draw your own conclusions from your own research. And you need to be making investment decisions that are suitable for your personal financial situation. And I'll add, parenthetically, also make investment decisions that are suitable for your personal level of risk management. Finally, I am not a licensed financial professional. I'm just a guy who draws lines on charts. Well, here we are. Finding ourselves, let me adjust my chart here just a second. You don't need to see all that stuff over there. There we go. Finding ourselves at the end of the day at 1593.01. We came within about just under 3 points shy of tagging 1600. The S&P is in all-time high territory, and I wouldn't go long here for any amount of money. Now, I might buy an individual stock if it's extremely compelling. But as far as just trading on market fundamentals, I made the comment in the little forum we've got. By the way, I wish more of you guys would participate there, because we got some real thoughtful posters. It's just there's only about a half dozen of us, it seems. And we got lots more subscribers to the service than we have people who post. So I'd love to see a little bit more activity over there, and I need to do that myself. But what I want to say is, in Edwards and McGee's technical analysis of stock trends, John McGee says the simplest concept of all in technical analysis is that when a price level appreciates as a stock price goes up, it automatically gets weaker and weaker technically. And you might say to yourself, yeah, but I've seen times when stocks go up and all of a sudden there's just this huge rush of activity, and it's like, wow, I can't believe the amount of buying that just came into that market. And we're going to take a look at a couple of charts. I want to show you a couple of examples. Matter of fact, we'll do that right now. We're going to start out with a chart of Apple. For a long time, Apple had been in this channel defined by these two lines. Now, this channel really worked mostly for identifying the bottoms, and that is the way it should be in a bull trend. The tops were running a little bit ragged. And then you can see that in the middle of, well, actually in the spring of 2012, Apple blew out over the top of this ascending channel. Additionally, it blew out over the top of an even longer standing trend line that I'm not as solid on this line as I am this one back here, but you can see this goes back quite a ways. But we only have a couple touches. It blew out over that. Then it actually bounced on that top line, made another big move up here, and everybody was talking about see you at 1,000. Apple is just going to go on up and up and up and up. There's no stopping it. And look here. What ended up happening, even though I thought this first move up here would have been a top, It ended up being the second one. But all of which took place over this upper line. Now, what really is the pattern that Apple made right here? Well, I've highlighted it right here. This is a Head and Shoulders top. And what kicked that top into formation was initially that thrust and that move above a well-established, but again, like I said, this line did run a little ragged, but it was an exorbitant move. Is that the right word? It was an exuberant move from about 375 to the mid 600s with almost no interruption. Then we got a little pullback. And then what happened here? Well, this was when Joe Retail, I think, probably went all in, and everyone started buying Apple. Then, finally, most people who were your more savvy investors unloaded up here in the high 600s, and now we find ourselves Apple at 434, struggling as the markets keep rising. Apple continues to struggle. Eventually, I believe Apple will come down to about 368 as a minimum target from this Head and Shoulders top. Let's take a look at another chart. Here's a chart I wish I had trusted and paid attention to, but I didn't, and no use being regretful at this point. But this is silver. Silver was in a channel that lasted about 2 years. Inverted Head and Shoulders. Here's the inverted Head and Shoulders. Target from that pattern. Again, we measure the depth of the pattern. Target was about $42.50. Big move over the neckline, a little consolidation, a little flag here formed at half mast, then a big move up over this line that really spelled top. So there's another example where a top was formed in a move that seemed to defy all technical sensibility, other than the fact that we were expecting 42 from this pattern back here. Finally, let's take a look at one more thing. Now we've sort of come full circle. We're back to the S&P, looking at a weekly chart from about 2004 until late 2006. The S&P was in a nicely defined little channel. When did the top get put in? It got put in the impetus, and I believe where the technical weakness was introduced first into the market. Again, like McGee says, just going up makes things automatically weaker, because you've got more people who have bought in at a higher price who would panic if things turn against them. And you also are now you get up to a level where people are less and less inclined to help out, because after all, I mean, what drives stocks is there somebody there to buy it at an appreciated value? And what happened here is in late 2006, the S&P rallied over this top resistance line, then rallied even more over it and made like a double-headed Head and Shoulders pattern up here that marked the top of the market. And I will remind you that this top was put in before anybody was talking about Lehman Brothers, before anybody was talking about Bear Stearns, before anybody was talking about the subprime mortgage crisis and default credit swap. None of that stuff was on anybody's radar when the top was put in. But what was the signal? Getting up and over this line in just this move that looked to be almost unstoppable, yet it was the very thing that stopped the market. I'm going to back out one more time here. we're going to look at a 9-day chart. And I just want to, we're going to kill this line here because I want us to be able to keep a good eye on this red line that is drawn over the market top of 2000 and the market extreme top of 2007. That is the line that we are oh so close to touching. And I'm not going to be, I'm going to try not to get too cute, because I think calling a top up around here would be about as difficult as calling a bottom down here in 2009. And there were some people who got this right, but I think they got it right primarily out of luck. So, because there were still people who were saying, no, we're looking at 400 in the S&P, and now here we are up close to 1600. It's not easy, but as we see what has gone on over the past few days, I want to show you it looked like we were in this ascending little wedge pattern that broke last week. And it looked like we were really setting up the potential for some serious weakness. But the market rallied back up. And then, of course, as we back tested this bottom broken line here, that's when the when the Fed minutes were released. And yesterday, creating again this accelerated buying spree that moved the markets. Really, if you look at it, we've gone from 1540, and we were expecting a bounce at 1540, but we've gone from 1540 to 1593, a 53-point move in about a week. So as we look at the chart now a little bit closer in, just want to show you a couple little things. And again, I'm not going to try to call a top. I think we're probably near one. But I don't think I want to lead anybody astray. So what I'd rather do is just look at our little patterns and do what we've done all along. Look at support and resistance, and where we can find one, let's look at a pattern. And what I see here is a little potential pattern that could either be a bull flag. If so, it would imply that the market does want to tag this line at 1600 or a little above. But if this bottom line goes, then we're looking at a very small head and shoulders or triple top. You know, it's 6 of one, half dozen of the other. Additionally, going out to an hour chart here, if we zoom back, I want to show you we introduced a new line on this chart yesterday. And this is drawn over the early February peak right here. And this peak that was the, at the time, the back test to this broken red channel. So basically what I did was I said, well, this looks to be a significant point, because when we came up here, the market started to sell off, and once we rallied back up, well, never mind that explanation. Just look at the line. If we back out to 2 hours, you can see where it's drawn. It's drawn over the last two, if you will, conspicuous tops that line up. Now, I know you might say, but Jim, that's not a top. And you would be right. But that was the last time the S&P touched our top resistance line in this channel. And this line just so happens to be, or rather this peak just so happens to be when we made a more full back test on that line. So there you have it. Hitting the top line, the resistance line, breaking down, rallying back, and then this was the final peak that was put in the back test of this line. If we extend that out, you can see that that sort of seems to have put the brakes on the market, at least temporarily. But I'm not going to be so foolish as to say this is where you short, because I don't know if it is or not. So, boy, you're thinking, oh, you're some help. Well, just telling you, it's not easy picking the top any more than it is easy picking the bottom. But what I can tell you is when we look at one of these longer term lines, and if we draw it here, we could make the case that this little lime green line should be here and just let this go over it, because this was a top. Okay, we are now over this line by a sizable margin, by about 3%. So, and this is one long rally that is yet to see any corrective a counter trend. We just haven't gotten it. I promise you this, it will come. And I'm not going to consider any, what's a good way to put this? I'm not going to consider any market-wide bullish moves until we get a significant correction to a level where we would expect some support. And that could happen in a couple different areas. Since we're nowhere near these areas, I'm not even going to bother mentioning them. But I will say this red line is a candidate, this blue line is a candidate. So guys, there you have it. That's the video for April 11th, 2013. We are still above this yellow line, and that is the line that we've been watching as our signal. Once this line breaks, then the party is almost certainly over. But it hasn't broken. This line, by the way, goes all the way back to November. I have to redraw it now, but I can do that. This line goes all the way back to mid-November 2012. It has lasted for 1, 2, 3, 4, 5, over 5 months. So there you have it, guys. Interesting days. Let's see where we finally get this S&P to turn over and take out some of these support levels so that the market can exhale some dollars, and then be on the watch to see if it is worth expecting another deep breath in. I'm undecided because of where we are and how close we are both to this red all-time tops line, and also, even though I don't like old wives' tales, we got our sell in May and go away indicator that we're very close to as well. And that has worked for the past 3 Mays. That would have been a good move. This sure looks to be setting up to be number 4. But until it is, it's not. Guys, thanks for watching. Thank you for your support. Take care.